Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
Every time the Federal Reserve, tweaks interest rates, there's this one company you probably just think of as a boring back office payroll processor.
Right, totally under the radar.
Yeah. But they quietly make or lose tens of millions of dollars without selling a single new product.
It's wild.
It really is. So today we are taking a deep dive into Paychex, ticker symbol PAYX.
A flag.
Exactly. We've got this really comprehensive research report from Compasscope, and we're looking at it alongside the actual Q2 2026 earnings call transcript.
Which is super fresh.
Super fresh, yeah. And for anyone fascinated by how businesses grow, defend their turf, and, manage their money, Paychex is basically a masterclass.
It really is. I mean, they're a legacy giant,
Yeah.
but they're navigating this whole AI-driven world right now.
Right, and integrating the largest acquisition in their entire history.
Yeah, the Paycor deal.
Which we will definitely get into. Plus, they act as this literal, real-time barometer for the health of the U.S. economy. Okay, let's unpack this.
So, to truly understand Paychex's current strategy, we really have to look past the name on the building.
Because it's not just checks.
Right. You assume they just print checks and calculate tax withholdings.
Yeah.
You completely miss the actual economic engine.
Yeah.
We need to define their turf first. They target the SMB market, small and medium-sized businesses.
Right.
Technically, they define that as companies with anywhere from 1 to 1,000 employees.
That's a pretty wide range.
It is, but the reality on the ground, their average client has fewer than 50 employees.
Oh, wow. So much smaller than people think.
Exactly. We're talking about, the local plumbing company with a fleet of 10 trucks, or maybe a mid-sized accounting firm.
Or like a regional bakery chain.
Spot on.
That specific size is a weird operational purgatory.
I mean,
Well, like a 40-person plumbing company is way too big for the owner to just sit at the kitchen table on a Sunday night and do payroll on a spreadsheet.
Absolutely. That's a nightmare.
Right. But they're also too small to hire a full-time 6-figure HR director and a dedicated compliance officer.
Right. They can't afford that overhead. And that gap is exactly what Paychex monetizes.
Right.
They basically build their revenue through 3 interconnected models.
All right, let's break those down.
So the first is what they call management solutions.
Which is the software, right?
Yes, mostly. It includes the core human capital management platforms, stuff like Paychex Flex, SurePayroll, and their newly acquired Paycor platform.
Got it.
But it's so much more than just hitting a button to run payroll. It's, time and attendance tracking.
Oh, right.
Imagine the headache of calculating overtime for 30 plumbers working across 3 different counties.
Oh, gross. All with different local tax jurisdictions.
Exactly. It's a mess.
Yeah.
And this segment also includes administering 401k retirement plans and managing really complex HR administration.
So it sounds like they are basically solving the math problem of having employees.
That's a great way to put it.
But, software alone is a commodity, right? Anyone can write code to calculate taxes these days.
Right, which brings us to their second and arguably much more defensive revenue stream.
Okay.
The PEO and insurance business.
PEO.
Yeah, professional employer organization.
Ah, okay.
Through this mechanism called co-employment, Paychex literally, legally becomes the employer of record for their clients' workers.
Wait, really? For tax and insurance purposes?
Exactly.
I always look at that co-employment model like an outsourced corporate headquarters for Main Street.
Totally.
Because, you start a bakery because you love baking, not because you love navigating multi-state labor laws.
Right, or negotiating dental premiums.
Exactly. So under a PEO, Paychex takes its massive pool of, hundreds of thousands of workers?
Millions, actually, across all their clients.
Right. So they go to a major insurer like Blue Cross Blue Shield with that massive pool, and they negotiate enterprise-level discounts.
Massive discounts.
So suddenly, this 20-person bakery can offer Fortune 500-level health, dental, and vision benefits to its bakers.
Which is huge for retention.
Yeah. Well, Paychex just absorbs all the headache of compliance and workers' comp.
And that stickiness right there leads to the third revenue stream, which is purely financial.
The float.
The float. It is the interest on funds held for clients.
Which is just wild to me. I think of the float like a massive rolling escrow account.
That's exactly what it is.
It's like, okay, imagine you take your friend's rent money on Tuesday. You put it in a high-yield savings account for 3 days. You keep all the interest for yourself, and then you finally pay their landlord on Friday.
Nice setup if you can get it.
Right. Now
Yeah.
multiply that by billions of dollars of corporate payroll.
Yeah, when a business owner runs payroll, Paychex pulls those funds from the client's bank account a few days before the actual payday.
Just to ensure the money clears.
Right. And they invest those billions of dollars in short-term and longer-term securities.
Wow.
So when interest rates are elevated, this becomes a highly lucrative, virtually frictionless source of pure profit. I mean, it falls almost entirely to the bottom line.
Here's where it gets really interesting.
Okay.
Because if Paychex is sitting on this ultimate outsourced HR goldmine, and they're enjoying essentially free money from the float,
Right.
who else is trying to steal that job?
Oh, lots of people.
Because at the bottom of the market, I am constantly seeing ads for sleek app-based startups like Gusto or Square.
Sure, yeah.
Aren't those cloud-native companies just eating Paychex's lunch? I mean, they're incredibly cheap, and you can set them up on an iPad in like 10 minutes.
What's fascinating here is the life cycle of a growing business.
Okay.
At the absolute bottom of the micro-business market, those ecosystem players you mentioned, like Intuit, Gusto, Square, they absolutely win on low-friction self-service onboarding.
Right, because it's so easy.
Exactly. But businesses quickly hit a mechanism that we can call the complexity wall.
The complexity wall.
Yeah. Let's say your 20-person bakery does really well, and you decide to hire a remote graphic designer.
Okay.
And that designer happens to live in California.
Oh, California labor laws. Yeah, that changes everything.
Right. Suddenly, you trigger this cascade of multi-state tax liabilities, specific break time laws, new workers' comp requirements.
And a simple self-serve iPhone app isn't going to hold your hand through a Department of Labor audit.
Exactly. And this is where Paychex's massive competitive moat activates.
Ah.
They operate a hybrid model. It's sophisticated technology paired with actual human HR advisors.
Right, real people.
Yeah. When the legal stakes get high, business owners willingly abandon the cheap startup software for the safety of Paychex's compliance umbrella.
Which makes sense. And that transition creates incredibly high switching costs.
Huge switching costs.
Because payroll is mission critical.
Hmm.
If you mess up a software migration, people literally don't get paid.
And they quit.
Exactly. Nobody wants to rip out their HR software if they don't absolutely have to.
No.
But looking at the CompuScope report, the competitive landscape above that micro tier is heavily segmented.
It is. It's entirely stratified by company size.
Right.
At the absolute top, dealing with massive multinational corporations, ADP is the dominant player.
ADP, yeah.
And Paychex doesn't really try to fight ADP for, like, a 50,000 employee global enterprise.
That's just not their game.
No. Then in the middle market, you have cloud-native darlings like Paycor,
Right.
which relies on a single unified database architecture, and Paylocity, which wins by offering modern employee engagement tools.
Got it.
And for clients who only want the co-employment model without the whole software ecosystem, they face pure-play PEO specialists.
Like TriNet and Insperity.
Exactly.
But despite all those competitors, the CompuScope report highlights something staggering.
Yeah,
Paychex generates gross margins above 70%.
it's incredible.
In the B2B world, that implies an incredibly low customer acquisition cost. How are they finding these clients so cheaply?
Well, it comes down to a really powerful, intangible asset, their referral network.
Ah.
Roughly 50% of new Paychex clients are brought in through existing client referrals, or, crucially, CPA referrals.
CPA referral.
Yeah. Think about it. When an accountant sees a small business owner making an absolute mess of their payroll taxes, the accountant recommends Paychex.
Right, because it makes the accountant's life easier.
Exactly. It acts as a liability shield for the CPA, and it serves as a massive free lead generation engine for Paychex.
That is brilliant, but that creates a fascinating dilemma.
How so?
Well, Paychex already dominates a relatively mature market. You can't just sit around waiting for new bakeries to open up or for CPAs to send you leads and expect to appease Wall Street's demand for aggressive growth.
True.
So how do they actually expand the engine?
They execute a three-pronged growth strategy.
Okay.
The first is maximizing the value of the clients they already have through organic upselling.
Right.
They want to move a client from basic, standalone payroll processing into a much more premium bundle.
I look at their organic growth like a fast food combo meal.
I like that.
Yeah. Paychex gets you in the door with a cheap basic burger, which is just a simple payroll processing.
Right.
But the real margin growth, the actual profit driver, comes from getting the business owner to add the fries and a drink.
Exactly.
That means upselling them on the time and attendance software, making them use Paychex to administer the company 401k, or eventually moving them fully into that premium PEO service.
Which is where the real money is. And that leads to the second component, inorganic growth.
Through acquisitions.
Right. Driven specifically by their recent acquisition of Paycor.
Which was huge.
The largest acquisition in Paychex's history. It's a strategic maneuver to literally buy their way into the mid-market.
Because Paycor's software architecture was specifically built for companies with, 100 or more employees?
Exactly, which is a segment where Paychex has historically really struggled to gain traction against competitors like Paycon.
So they just bought the audience.
They bought the audience and the technology. And the aggressive goal now is cross-selling Paychex's proprietary PEO and retirement products directly into Paycor's existing client base.
Right.
They're explicitly targeting $100 million in cost synergies by fiscal year 2026.
100 million? That's no joke. Which brings us to the third growth component, and the one that is dominating literally every industry right now.
Oh, yeah.
The AI revolution. But according to the research, they aren't just slapping a basic customer service chatbot on their website and calling it a day.
No.
They're deploying agentic AI.
Right. And agentic AI represents a fundamental shift in how the software operates.
What does it actually do?
Well, instead of a traditional AI that simply reads a prompt and points a user to an FAQ page, an agentic system takes autonomous action.
Autonomous action.
Yeah. So if a small business owner emails their Paychex representative and says, hey, I need to give Sarah a 5% bonus on this Friday's check.
Okay.
The AI reads the natural language intent. It then securely logs into the back-end payroll system itself.
Wait, it logs in?
It logs in, calculates the specific tax withholding for that bonus in Sarah's state, and stages the final payment for a human to approve.
That is wild. The AI is actually doing the keystrokes.
It is.
The report also mentions a patent-pending knowledge mesh.
Yes.
To translate the tech jargon, it sounds like they're taking massive amounts of messy, unstructured data like angry phone calls about missed punch-ins, confused emails about tax forms, and turning it into a structured, searchable database without a human ever having to manually enter notes.
Exactly. And the strategic goal here isn't to fire all their human HR experts.
Right, which is what everyone assumed.
Right. The goal is to use AI to completely absorb the low-value, repetitive transactional work.
So just the data entry.
Yeah. By automating the data entry, they free up their specialized staff to act as high-value, proactive advisors.
Got it.
That human-in-the-loop model is what differentiates them from a pure technology provider.
Okay, but wait. Expanding the product menu, integrating a massive new company in Paycor, and rolling out autonomous AI that touches people's actual paychecks.
It's a lot.
This sounds incredibly delicate. And they took on about $5 billion in debt for that Paycor acquisition.
They did.
That brings their net debt to EBITDA ratio above 1x. For context, in the broader software world, 1x is actually quite conservative.
Very conservative.
But for a legacy company like Paychex that is used to running a pristine, virtually debt-free balance sheet, that is a completely new, highly leveraged posture.
It completely changes their risk profile. I mean, the execution risks are vast.
Let's talk about those.
Start with the Paycor integration itself. You're dealing with a monumental collision of technology stacks, corporate cultures, and go-to-market strategies. They have to seamlessly migrate certain clients between the legacy Paychex Flex platform and the new Paycor platform based on what fits the client size best.
That sounds messy.
It is. And they have to accomplish this without degrading customer service. And crucially, without causing channel conflict.
What's channel conflict?
That's where a Paychex sales rep and a Paycor sales rep are fighting over the same mid-market commission.
Oh, yikes. Yeah, that would be bad. Combine that integration risk with their heavy reliance on small businesses.
Right.
Because in the U.S., roughly 18% of small businesses fail in their first year.
It's brutal.
And about 50% fail within 5 years.
Yeah.
Paychex reports customer retention in the low 80s, but a huge component of that churn isn't because clients are getting mad and leaving for ADP.
No.
It's simply because the client's bakery went bankrupt.
Exactly. They just closed their doors.
Taking on $5 billion in debt when your primary customer base has a coin flip chance of surviving the decade seems like a terrifying recipe for disaster if the macroeconomic environment takes a nosedive.
You might assume that, right. That debt load combined with fragile SMBs is a death sentence during a recession.
Right.
But we have to look back at those 70% gross margins.
Ah.
Their free cash flow generation is so incredibly robust that they can absorb a massive spike in SMB bankruptcies, weather the churn, and still easily service that debt.
That's impressive.
It is. However, you are absolutely correct that they are exposed to cyclicality.
Because they charge per employee.
Right. If the economy dips, new business formation stalls, existing businesses lay off workers, and since Paychex charges on a per-employee basis, their volume revenue drops.
Plus, there's the risk of falling interest rates impacting that float income we talked about.
Oh, absolutely.
If the Federal Reserve starts a heavy cutting cycle, the yield on those billions of dollars in escrow just evaporates.
And we cannot ignore the AI execution risk.
Right, the autonomous agent.
When an autonomous agent is handling payroll and compliance, the stakes are existential.
Because if it messes up.
Exactly. If the AI hallucinates or gives out illegal labor compliance advice or causes a data privacy breach involving personally identifiable information, the trust is instantly destroyed.
And in the HR outsourcing business, trust is the only actual product you sell.
100%.
So to see how they're navigating these exact risks in real time, we can look at their Q2 2026 earnings calls scorecard.
Let's do it.
On the surface, the top-line numbers looked spectacular. Total revenue was up 18% year over year, hitting $1.6 billion.
Right, but we do have to contextualize that 18% growth.
Okay.
The Paycor acquisition contributed about 17 percentage points of it.
Oh, wow. So organic growth was quite small.
Exactly. But the underlying operational metrics are what really stand out here.
Like what?
Their adjusted operating income grew an impressive 21%, which actually outpaced revenue growth.
Nice.
That proves they are extracting real operational efficiencies from the merger, not just buying empty revenue.
That's a great sign.
Yeah. And the PEO business is also thriving, showing mid-single-digit worksite employee growth.
You know, the number that jumped off the page for me was the float income.
Oh, the float.
Interest on funds held for clients spiked 51% to $54 million for the quarter. I know part of that is just adding Paycor's client balances into the pool, but the CompuScoop report highlighted a specific financial maneuver their treasury team pulled off.
Yes. It was a brilliant piece of active treasury management.
What did they do?
So, before the acquisition, Paycor's investment portfolio was heavily weighted in short-term securities.
Yeah.
Basically just writing the daily interest rates.
Right, playing it safe.
Right. But when Paychex's treasury team took over, they recognized the macroeconomic winds were shifting.
Okay.
They immediately reallocated those short-term funds to balance their long-term portfolio duration, effectively locking in high yields just before the rates began to soften.
Oh, that is smart.
Very smart. That deliberate repositioning drove a massive chunk of that 51% spike.
Wow.
They also announced they're raising their Paycor cost synergy target from the original $80 million up to $100 million.
Which Wall Street always loves to hear.
Always.
But reading between the lines of the earnings transcript, the chief financial officer, Bob Schrader, sounded a bit cautious.
He did.
He described the current B2B selling environment as a definitive shopper's market.
Yeah, that phrasing was telling.
Clients are highly cost-sensitive, deal sizes are shrinking, and the initial attachment of those extra software modules at the point of sale is coming in lower than they modeled for.
If we connect this to the bigger picture, it really reveals a fascinating dynamic in B2B psychology right now.
How so?
Well, business owners are hoarding cash and suffering from decision fatigue in a high inflation environment.
Oh, for sure.
When a Paychex sales rep pitches the good, better, best software bundles, buyers are actively refusing to overextend themselves.
They're just playing defense.
Exactly. They are opting for the lower tier basic packages on day one. Paychex is still winning the logo, they get the client, but they're going to have to work much harder to upsell those clients later on.
And it wasn't just on the software side either. The insurance agency side of the house saw serious headwinds.
Right.
They cited weak workers' compensation rates and lower overall health benefit volumes. Small businesses are just tightening their belts across the board.
They really are.
So what does this all mean?
Well,
The external environment is full of stingy, budget-conscious clients, but Paychex is successfully pulling internal levers.
right.
They're deploying AI to cut service costs, executing treasury maneuvers to maximize float yield, and squeezing out more Paycor cost synergies.
To counteract that external friction.
Exactly. The macro environment is tough, but the machine is running efficiently enough to completely absorb the blow.
And they even raised their adjusted earnings per share guidance to 10% to 11% growth for the year.
Wow, up from their previous 9% to 11% range.
Right. Finding ways to expand profitability in a shopper's market is the ultimate test of a management team's discipline.
Truly. Taking all this analysis into account, if you are keeping a close eye on Paychex over the next few quarters, what are the critical dashboard dials you need to monitor?
Let's build a watch list.
Let's do it.
The primary dial is U.S. SMB health.
Always.
You need to monitor national small business formation data and failure rates. Paychex is fundamentally tethered to the heartbeat of Main Street.
Makes total sense. Dial number 2 has to be the Paycor synergy realization.
Right.
We need to watch if they actually hit that $100 million in cost savings. And more importantly, we have to monitor their success in cross-selling the PEO and retirement products into that new mid-market base.
Definitely. And third is revenue per client.
Okay.
We need to see if this current shopping behavior is a permanent shift or just a temporary blip.
Will the cautious clients who bought the basic bundle today eventually upgrade to the premium bundles when the economy feels safer?
Exactly. That delayed upsell motion is vital for their organic growth projections.
Got it. And dial number 4 is AI monetization.
Oh, this is a big one.
The Compass Scope report noted they have over 250 million data points for compensation insights alone.
It's a massive data set.
If you are a plumbing contractor in Ohio, you desperately want to know exactly what the market rate is for a journeyman plumber right now.
Right, so you don't lose your best guy to a competitor.
Exactly, and Paychex has that exact real-time data. The question is, can they productize that data and charge a premium subscription for it, rather than just using AI to cut their own internal operating costs?
And this raises an important question regarding their long-term cost structure.
What's that?
Well, Paychex has publicly targeted operating margins expanding toward the mid-40s by fiscal year 2030.
Okay.
But they employ thousands of highly specialized compliance experts, tax professionals, and software engineers.
Right, real humans.
Can they actually maintain or expand those margins if wage inflation for their specialized human staff outpaces the savings they're generating from their AI deployments?
Yeah, that is the ultimate tug-of-war for literally any service business right now.
Absolutely.
To wrap this deep dive up, Paychex is a profoundly fascinating study in corporate evolution.
It really is.
You have this highly defensible legacy small business franchise that is aggressively using modern M&A with the Paycor deal and cutting-edge tech like agentic AI to raid the mid-market and optimize their margins.
They aren't just processing paychecks. They are a window into the American economy, playing out in real time.
It's amazing.
They have proven their resilience over several decades of economic cycles. The real challenge now is proving they can be just as agile in an era where technology and the very nature of employment itself is moving faster than ever before.
Which leaves us with a final thought to ponder. We talked earlier about Paychex being the outsourced corporate headquarters for Main Street.
Right.
As AI increasingly automates the human out of human resources across the entire software industry, will the ultimate luxury for a small business be a platform that actually connects them with a real human expert when a legal crisis hits?
Yeah.
And is a legacy company like Paychex uniquely positioned to sell that exact luxury? Thanks for joining us on this deep dive. Keep questioning the world of business around you.
This content is produced by Compasscope.com. For more than 1,100 public-listed companies, find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.